Hello, Scott, and thanks so much for joining us today for our ESG Investment Influencers series. I'd like to start today by just asking you about what's really driven your passion for ESG investing and what really interests you about this part of the market.
Yeah, sure, and thanks for having me. I mean, I've been involved in running ESG portfolios since 2000. You know, back when it was actually called ethical. I guess it's something that I'm encouraged by, to see that both, you know, how the industry's kind of developed and deepened to where we are today, and I think that's kind of, you know, gives me kind of comfort that we are on the right track. I mean, back then it was all about kind of avoiding the kind of sin areas of the markets, you know, kind of tobacco and so forth. But I feel in particular that this is kind of misses out on a lot of the kind of opportunity set to both make an actual difference from an ESG stance, but also to kind of make a profit. Many of the better returns you make are actually investing in businesses that are transitioning or kind of changing, rather than already being kind of green. And it's always easier to encourage a business to change when you work with them, and that's obviously a lot easier if you're kind of a shareholder already. Engagement in particular is something that I'm quite passionate about, and all active funds, not just kind of ESG labeled funds, should be doing kind of engagement in certain areas. Very much kind of believe that we want to focus on having a cleaner planet in the future, rather than having a pure clean portfolio now.
Yeah, and it's interesting to hear you reflect on that huge change during your career in attitudes towards this area. Where do you think that the industry is at the moment on this journey to ESG becoming mainstream?
I think we're still, you know, quite early on. I mean, if you look at kind of AUM on funds in the kind of IA kind of responsible sector, I mean, it's still only 4% of the total IA industry. So that would kind of tell you that we're, you know, why it is growing, and, you know, it's had 2 good years of rapid growth. It's still very much kind of early days. But it's my view in particular that all good fund managers should be doing some form of ESG analysis on security selection, not just, as I say, kind of certain responsible type funds. ESG in particular is about enhancing investment knowledge. It's not about product labeling. So, you know, ESG research is important for all active managers to help improve returns and reduce risk. I mean, studies from the likes of kind of Harvard Business School have revealed that, you know, a focus on kind of ESG metrics does produce superior kind of risk-adjusted returns in other companies. And I think also in a similar study, it announced that I think 17 of the S&P companies that went bankrupt between 2005 to 2015 had scored poorly on ESG metrics 5 years previous. So you can kind of see there on that study both the kind of possibility to enhance rewards as well as kind of reduce risk. And I think, again, it's important that all managers focus on kind of ESG, not just particular niche type products.
And let's talk a bit about how you've integrated ESG considerations into the BMO multi-manager range. How have you sort of gone about this?
Yeah, we've put a lot of work into this. I mean, it's something that we've always done. Obviously, more recently, I think over the last kind of 2 years, we've kind of made it a bit more kind of official. Our general belief, as I said, is that ESG is something all active managers should be doing when it comes to investing. But like investing, there's no necessarily right or wrong way of doing it. So what we've done, based on certain criteria and approaches, we've allocated every fund that we own, or every fund that we could own, our own kind of ESG score or award level to help determine that kind of fund's approach and focus on kind of ESG. These scores are kind of recorded within our fund note database and unchecked and maintained as part of our kind of regular contact with the manager, at least every kind of 6 months. An important point to note is that both our fund ranges, so we have 10 funds in total, 5 lifestyle funds and 5 navigator funds, we don't apply any kind of negative screens. We are not invest in the kind of underlying holdings because they don't invest in tobacco or they don't invest in gambling. We're happy to have kind of tobacco exposure or gambling exposure by our managers, but we want to assess that the manager has looked at them names and judged them worthy based on their own kind of ESG criteria. So they've looked at them and assessed the risks from kind of ESG rather than just kind of ruling them out completely. So in terms of the kind of scoring metrics we've designed, it's based on kind of 5 criteria: gold, silver, bronze, non-runner, and disqualified. Obviously, we kept a kind of a sport and Olympic theme with this, you can see. So if I run through them all, disqualified is kind of what it says in the tin. So these are funds that can consider ESG, but do not. So if you've got a manager who doesn't even consider any of the kind of ESG implications of his stocks or bonds, we would argue that that manager is not fully embracing what he should be doing as an active manager. We will engage with them to kind of see why. If we're not satisfied with the answers, we won't invest with that, and we would actually kind of disqualify that fund from our kind of potential universe. It's pleasing to see that that's never been the case, but it's there. The non-runner, these are funds that are due to their kind of asset class, cannot apply ESG factors to their decision making. So an example would be, we have a holding in Allianz UK index-linked gilt. It's near on impossible to apply any kind of ESG criteria, given that you can only invest in UK index-linked gilts. Similarly, these would be kind of passive products, like a FTSE 100 product, also cannot apply to any form of ESG criteria. We didn't want to rule these funds out of our universe just because of the kind of asset class, so we kind of class them as kind of non-runners. Bronze, coming into the actual kind of scoring metrics, bronze is where we find lots of our kind of managers kind of qualify. These are funds or teams that consider ESG in their selection process, but it's less formal. Perhaps they don't have a separate ESG score for their stocks, or they don't have a kind of separate kind of dedicated ESG resource or team. Examples of holdings here would be boutiques like Lindsay Train, which I'm sure many people are familiar with. It's something that they consider when looking at their stocks, but they don't have a huge dedicated resource or scoring system when it comes to ESG. We are seeing kind of an increasing amounts of resource being added to ESG factors, especially through some boutiques, which is pleasing. But at the moment, lots of the kind of boutiques we invest in would kind of naturally be kind of this kind of bronze kind of criteria. Moving up, silver is the next level up. These are still managers and teams not picking stocks solely on ESG, but it plays a lot bigger part in their formal selection process. So firms here probably have a dedicated resource to this space. An example here would be something like Hermes Asia, where it doesn't badge itself as a kind of ESG or responsible fund, but the team have a big resource and especially in terms of engagement, and have kind of lots of kind of tools and information at their hands. And again, something when you look through the portfolio, you can question a lot of their stocks, but they've been very big into the kind of engagement process with their managers. And finally, gold, which is obviously the highest scoring metric. We feel to be gold, you need to be above and beyond kind of ESG. So not just kind of fully ESG integrated, which would kind of be your silver, but you've got to be kind of focused on areas of sustainability. And we measure sustainability by investing in one of the kind of 17 themes set out by the Sustainable Development Goals, United Nations goals. So here would be something that we have very few golds in our portfolio. Something that would be gold would be something like Target Healthcare REIT that solely invests in kind of nursing homes. I mean, there's a clear link to nursing homes and the Sustainable Development Goal number 3, which is about health and well-being. So golds are quite hard to achieve, and it's something that's probably more focused towards kind of sustainable funds or impact funds, which again we would stress are quite different to kind of ESG funds. So that was that in a brief way.
In a nutshell. I know you said you've been obviously considering ESG for a number of years, but this has become more formalized in the last couple of years. Using this framework that you have and looking at the funds that were in the portfolios, were you quite surprised by some of the scoring when you were actually looking at it, or were there funds that you went back to the manager and were sort of saying, look, after putting it through this system, we'd like to see some improvements there, or how did it sort of map onto what you already had in the portfolios?
Yeah, I think we were probably more positively surprised than we thought we would be when doing the initial scoring. It does turn out, and again, this is something that the industry as a whole can be better at, that most decent active managers actually have been doing ESG for years. They just haven't been shouting about it, and they actually do have their own kind of metrics which they've been looking at all stocks from a kind of ESG lens. It just, up until recently, hasn't been such a big part of their kind of sales pitch or presentation. Again, this would include kind of, there were certain fund houses that are big about shouting about it, but there were kind of certain smaller houses and managers that have always done it this way, but just not really kind of, as I said, been shouting about it quite loud. So when we actually look through many of the portfolios with a kind of ESG lens, we were pleasantly surprised, especially on the kind of governance side of the kind of ESG. That is something that we found that a lot of managers have done a lot of work on, and tended to be ahead of where a lot of the criteria even today states that they need to be at. So again, it was positive, and I think what we've seen more recently is more fund houses get better at kind of promoting that message. Doesn't mean that the funds have changed or changed their process. I just think they've got a bit smarter about talking about the metrics of their portfolios when it comes to kind of ESG.
And yeah, trying to sort of cut through this greenwashing sort of risk there. What are the big red flags for you when you speak to, especially new managers that you haven't met before? I mean, every group, every manager says they're integrating ESG, aren't they? But I mean, how are you really working out if they're actually doing this? By drilling down portfolios and testing that against what they're telling you in the marketing, or how does that work?
Exactly. I mean, we think greenwashing is a real issue, and you do not see, as you know yourself, you don't see a fund presentation now without at least one or two slides dedicated to how ESG friendly the portfolio is. The key for us is to continue to test the manager or team on what they say they do to what's actually in the portfolio, and getting them almost to kind of explain it. As I said, there's no right or one way to run money, but a good fund or a good fund manager will find a way that works for them. And this is similar for ESG integration. A manager needs to find an approach that works for them, but what they need to be is honest and transparent on this. We're not saying we need all our underlying portfolios to avoid sin stocks and just focus on kind of sustainable stocks, but we want to be able to see a kind of trace back to how and why it's kind of in the portfolio from an ESG point of view. So if I'd mentioned something like Hermes Asia, which, as I said, we gave it a silver ranking. We've got you look at their portfolio. I mean, if you look at their portfolio through some of the kind of tools that we have, so we use style analytics that I think uses MSCI data, and you can kind of see how their portfolio screens from an ESG integration. It doesn't flag up like it's a very ESG friendly portfolio, but then when you engage with the manager as well as the kind of separate team that they have there, you can see how they're probably a little bit ahead of the curve when it compares to the likes of MCI in terms of how these companies are transitioning. And there's lots of issues with, which I'm sure we can get to, there's lots of issues with some of the kind of data providers out there at the moment. I think they probably need to raise their game a little bit. But there's no substitute to kind of meeting the manager or meeting the teams and kind of just continue to build and test that knowledge that we have. It's a kind of involves a lot of hard work and a lot of meetings, but that is the best way to really get a feel for how kind of ESG friendly or how important ESG integration is to the manager, rather than are they just paying lip service to it to sell units.
And what about the parent fund group in all this? I mean, we've been talking about you meeting the managers and drilling down into that fund, but how important is the ESG credentials of the wider parent company in all this?
Yeah, I think it's important. I mean, the house policy does have an impact, for instance, on any kind of on the portfolio. And there's a clear link to how important the house or investment company takes ESG to the amount of resources they dedicate to ESG. But when we look at investment houses and their approach, we are very much aware that some of the larger investment houses have kind of larger teams and larger budgets and have allocated a lot more resources to it. But that doesn't mean that they automatically get a pass. We have found a couple of examples where the house may consider themselves very kind of ESG, but different managers that work for that house have different kind of interpretations, and that has resulted in us having different scores from the same investment house. So the investment house may have a fund that is a silver, but they also may have a fund that is a bronze, and that's just about how the manager interprets the policy or how much he actually uses that team. It might be fine that the investment house is a dedicated kind of ESG team, but if the manager doesn't really use it, then it's a wasted resource. That's why I think it's important to have the scores on the actual funds rather than the investment houses. There is a clear link, but I think it's important to kind of separate the two.
And what are you actually hearing from advisors in this area, and how are you sort of meeting their needs? What are they asking you about the ESG credentials of your multi-manager funds, and maybe you can say a little bit about reporting there. What do they want you to show them?
Yeah, I still think it's an early day, so we are beginning to see a lot more kind of questions on our kind of ESG criteria, which is a good thing. I would argue. I would say that I think the average advisor in this area probably would still benefit from more help in terms of education, in terms of what ESG is and how it can be beneficial. There are many advisors who have been looking at this area for a while and fully understand it and embrace it. But for those who have just started to explore ESG with their clients, it can look overly complex. For instance, I think the industry is not great at terms of consistency of language, and that can add increasing levels of confusion. Whether it's kind of is it green, is it ethical, is it ESG? We all know there's no end of terms being chucked around, and I think actually more recently we've seen in kind of Europe, from the SFDR, they've tried to help this by adding new terms to the conversation. So, funds that are classed as Article 6 now, or the classed as Article 8. I think that's helpful, but on the face of it, they've just added in more terms for people to get kind of confused by. What we try to do with our clients is take them on the journey with us when it comes to kind of ESG. Importantly, tell them what we do in terms of our funds. So our funds are all ESG integrated, and the client can rest assured that we're doing a lot of the hard work for them, that the portfolios are fully ESG integrated. But also to be honest and transparent with the client, to say that these are not funds that exclude certain areas, or these are not funds that focus solely on kind of sustainability. And if that's what you want, that's there are different products out there for you. It's about being honest and transparent about what our funds are, which are kind of ESG integrated, and making sure the client understands that, and importantly, what they're not.
And just asking you about product gaps in this area and product development. What are you finding sort of interesting, and where are the sort of gaps there?
Yeah, I mean, there's a lot of, more recently, what we've seen is a lot of kind of funds that have kind of come out that are quite similar. I mean, there are, obviously we all know the names, or there are those that have kind of been leaders in this field for a while and taken in a lot of money, and they're now kind of managers or houses launching kind of similar type of products. I think what we're very much aware of is that lots of these funds tend to own the same names. And when you're trying to build portfolios, what you kind of want is kind of diversification. What you don't need is, 5 different types of funds that all own the same Danish, offshore wind farmer. So it's important to understand the kind of diversification approach. And I think lots of these funds, from a kind of style point of view, have similar kind of style biases. So that will kind of be whether it's kind of quality or growth, they're in that kind of space. And I think in particular for, if you got UK onshore funds, there's not many funds that offer you something different. There's we found a couple in the offshore universe, which is helpful because we can shop there. But if you was only kind of relying on kind of funds that are on kind of platforms, in that, especially in that kind of sustainability aspect, lots of them funds are quite similar. And what you don't have is you don't have things that are different or offer you a kind of unique or different approach to sustainability. So an easy example would be, it's very hard to find a sustainable value fund on the kind of onshore marketplace, because obviously sustainability tends to be focused towards kind of growth and so forth. Doesn't mean that they're not there, but there's not many of them. So I think what we'd like to see is a more kind of wider breadth of kind of different types of sustainable funds, rather than just those that happen to kind of invest in the kind of same areas.
And just finally, before we finish this interview, could you maybe highlight a couple of funds in your range that you think are really excelling in ESG investing and what they're doing there?
Yeah, sure. I mean, obviously from larger houses, there are companies like obviously BMO and Hermes in Europe, or Rockefeller in the US that are leading the charge in kind of ESG and sustainability. But actually from a kind of smaller firm level, we're, as I said earlier, we're quite encouraged. So from an ESG integration, we're encouraged on the path that many of the smaller firms are taking in ESG. This is both from a combination of the team and the extra resources being added. It shows true commitment when it's a small firm, given that they don't have necessarily the resources of large firms. So investment houses like Finley Park, who only run one fund, the Finley Park America, have kind of started to step up their approach. And this is a fund that we've recently upgraded from our bronze metric to silver, given that they've formalized their ESG approach among their own analyst team, but also have allocated dedicated resource in a lady called Rose Beale, who again we have met, to kind of really beef up their kind of own ESG presence. And the same can be said about other boutiques. So there's a boutique we own called Memnon European, which is a European boutique based in London. And again, they really are kind of stepping up to the challenge on kind of ESG, and believe very much that their focus on it can help improve returns for clients. So that they're seeing it very much doing it for a return aspect rather than necessarily for a pure ESG metric. Also, I should, on some new launches on the sustainability side that I think are interesting. I think what Tim Crockford's doing at Jokum is very interesting in terms of building out a kind of his own kind of impact franchise there. And there's also other managers that I could name, people like Harry Thomas at TT is trying to build something quite unique. And again, these are firms that often aren't really kind of associated with the big boys in kind of ESG or sustainability, but they are trying to do something different, which looks encouraging.
Yeah, that is really interesting to hear about what boutiques are doing and some of these sort of new players and coming through and what they're working on. So it's definitely watch this space as this part of the industry develops. Thank you very much for sharing your thoughts with us, Scott, and we hope to see you again very soon.
No, thank you.